All right, deep divers. Let's dive into this Archegos thing, shall we? This isn't just another Wall Street crash, though it definitely was a crash.
Yeah, crash landing for sure.
This is about one of those family offices.
Right, the private investment firm.
For like the ultra-wealthy. And this one managed to blow up, lose billions, and like shake some of the biggest banks in the world.
Even brought down Credit Suisse, arguably.
Seriously. Credit Suisse.
Wow.
Okay, so we're talking secret deals, like, are we talking hush-hush trading tactics?
Wow, yeah.
And get this, a polo-loving trader who took a very interesting vacation, like, right after it all imploded.
Tried to slip away quietly, I guess. And, while this all went down back in 2021, it's still sending shockwaves. We're talking billions of dollars in losses, criminal charges.
Oh, wow, it got that serious.
Yeah, criminal conviction, actually. And now even central banks are scrambling, thinking about new regulations.
So how did we even get here? Like, how did Archegos, with all that money, just fly under the radar?
Well, a lot of people don't realize this, but family offices like Archegos, they don't have the same level of scrutiny as, say, a hedge fund.
Really?
Yeah, they don't have to register with the SEC, for example.
Interesting.
They play by a different set of rules. They don't have to make the same disclosures. So Archegos, they're able to build up these massive positions without attracting too much attention.
Like they were playing a stealth game with the global financial system.
Kind of, yeah. And it exposed a real vulnerability. Regulators realized that one family office operating in the shadows could pose a real systemic threat.
Which brings us to Bill Hwang.
The man himself.
The man behind the curtain. He's a fascinating character, right?
Yeah.
Like a devout Christian, lived modestly, but was worth, what, billions at one point?
Yeah, it's a real head-scratcher.
Quite a contrast.
Hwang had a history in finance. He made his name at Tiger Management. You've heard of that one, right?
Oh, yeah, the legendary hedge fund.
He was a big deal there. Then he started his own fund, Tiger Asia, also very successful. But then 2012, insider trading charges.
Oh, right.
Banned from managing outside money. That's when he pivoted, went the family office route, and created Archegos.
So Archegos was his, like, second act.
Pretty much. This time he was playing with his own money, essentially.
High stakes.
You could say that again. At its peak, his personal fortune through Archegos, it was $36 billion. But here's the thing. Despite all that wealth, he kept a low profile. He was known more for his, religious beliefs and charitable giving than for, like, extravagant spending.
Double life almost.
Yeah, in a way.
And speaking of double lives, let's talk about William Tomita,
What?
Hwang's head trader.
Right, Tomita. He's a pivotal figure in all this.
Because he flipped.
Exactly. Pleaded guilty to some serious charges, racketeering conspiracy, the whole 9 yards, agreed to cooperate with the government's case against Hwang.
So he gave them everything.
Pretty much. He gave them an inside look at how Archegos operated, how they used their buying power to, shall we say, nudge stock prices in their favor.
So he was the key, basically.
He was a gold mine of information for the prosecution. Described how Archegos engaged in, heavy pre-market trading, timed their trades perfectly to influence those closing prices, created this illusion of demand. And he claims it was all Hwang's orders.
And we're not talking small potatoes here, right? This wasn't just, oh, we have a hunch about this stock. They were moving billions, right?
Oh yeah, billions. Archegos wasn't just riding the wave, they were trying to create the wave. They wanted to pump those prices up no matter what. They weren't shy about throwing their weight around to make it happen.
And their tool of choice, total return swaps. TRSs.
Ah, yes, the infamous TRSs.
Break it down for us. It sounds complicated.
It can be. But imagine you want to bet on, let's say, a horse race, but you don't want to buy the horse.
Okay, I'm with you.
TRSs are kind of like that. You're betting on the outcome, the movement, without actually owning the thing itself. You sign a contract with a bank and they give you exposure to a stock's price moves up or down, but you don't own the actual shares.
So you're basically betting on a game you're not really playing in.
That's a great way to put it. And this is where it gets dangerous because, like you said, you're not putting down the whole amount for the horse, you're leveraging. Archegos, they were borrowing huge sums from banks to amplify their bets. So they had control of way more stock than their actual money would allow.
Ah, leverage. The double-edged sword. High risk, potentially bigger rewards.
But also the potential for massive losses, which is exactly what happened. Their whole strategy hinged on the market playing in their favor.
And when it didn't?
Well, they were overexposed. Their bets were concentrated on a handful of stocks. So when those stocks started to wobble, A house of cards, you know.
All those billions just
Yeah.
poof. What was the turning point? What actually caused Archegos to collapse?
It was a chain reaction, really. But the first domino was Viacom CBS. They announced they were doing a secondary stock offering, a $3 billion one.
Viacom CBS, the media giant.
The one and only.
Yeah.
Now, this type of offering, it's not uncommon, but it meant the value of their existing shares would get diluted a bit.
So the stock price?
Tanked. It fell by over 10%, which for most investors wouldn't be great, but manageable. But Archegos, they were so leveraged and they were holding so much Viacom CBS that relatively small drop set off a chain of margin calls from the banks they'd borrowed from.
Margin call. That's never good. Explain it like I'm 5 years old.
Let's say you borrow money from your friend to buy a cool toy, right? And your friend says, hey, if that toy breaks, you got to give me more money to make up for it. That's basically a margin call.
And Archegos borrowed a lot of money for a very fragile toy.
A lot of very fragile toys. So those margin calls, they were massive.
Oof, what a mess.
And if that wasn't bad enough, that same week, the SEC announces they're going to increase scrutiny of Chinese companies listed on U.S. exchanges.
Which Archegos had a lot of.
Bingo. Talk about bad timing. They were already on shaky ground, and this just threw gasoline on the fire. They created a perfect storm, and it was only a matter of time before
the whole thing blew up.
Exactly. But the damage, it wasn't just limited to Archegos. Those banks that lent them all that money, they took a massive hit. Billions.
Billions with a B. Seriously.
Oh, yeah. Credit Suisse. The biggest loser, sadly. They lost, get this, $5.5 billion.
No way.
To put that in perspective, their net income for all of 2020, it was only $2.8 billion.
So they lost double their yearly profit in a week?
Ouch. Right.
That's got to hurt.
It definitely hurt. But it wasn't just them. Nomura Holdings, another big bank, they lost $2.9 billion.
It's crazy how one family office could inflict so much damage.
It really shows you how interconnected the whole system is. One wrong move, and the ripples, they go global.
So Archegos goes down, takes billions of dollars with it, not to mention the reputations of some major players.
Yeah.
But the fallout, it didn't stop there, did it?
Not even close. This wasn't just a few bad trades. It exposed some serious cracks in the foundation, got people questioning everything, transparency, regulation, the power dynamics.
Yeah, how much power is too much power?
Exactly.
We'll get into all that after a quick break. Don't go anywhere.
So much damage and so quickly. I mean, it really sent shockwaves through the system. Everyone was suddenly looking over their shoulder, reevaluating their risk, especially when it came to these family offices. Right?
Yeah, like finding out the house you just bought was built on a swamp or something.
Exactly. And the first reaction, well, the regulators, they started tightening the screws.
Makes sense.
The Bank of England, for example. They took a hard look at their margin rules and decided, nope, got to be stricter.
Margin rules. I mean, I know it's important, but can we just recap that for a second for our listeners who don't live and breathe financial jargon?
Sure. So when you're buying stock on margin, you're essentially what? Borrowing money from your broker?
Right. Using their money to make your bets.
Precisely. And margin rules are like the guardrails. They say how much collateral you need to have to back up that loan.
So tighter margin rules mean less leverage, fewer people swinging for the fences with borrowed money.
Exactly. The Bank of England, they didn't want another Archegos situation, so they basically said, all right, everyone, calm down with the risky bets.
And they weren't the only ones. After Archegos went down, there was this whole global push for reform, right? Everyone was suddenly paying attention.
Oh, yeah, it was a wake-up call. The Financial Stability Board, which is the big global watchdog for the whole financial system, they said, okay, enough is enough. They wanted stricter rules on these margin practices, and they wanted more transparency, especially from family offices. They basically wanted to drag them out of the shadows.
And how did that go over? Are family offices, on a tighter leash now?
It's a bit of a mixed bag, honestly. There's been some progress, sure. More people are paying attention, and there's definitely more talk about transparency. But the thing is, family offices still have a lot of leeway. They're still arguing that they're not systemically risky, that too much regulation will stifle their investing.
So it's this balancing act, right? Regulators want to prevent the next Archegos, but family offices want to protect their, privacy and flexibility.
It's a tough one. And in the meantime, the banks that were caught in the crossfire, they felt the heat immediately.
Yeah, no kidding. They learned the hard way about due diligence, right? Really understanding who they're lending to.
Billion-dollar lessons for some of them. The Archegos situation, it exposed some blind spots. They underestimated the risks, got a little too comfortable, and paid the price.
And it wasn't just about money, right? There were some serious reputational hits, too.
Oh, yeah. Reputation is everything in this business. Credit Suisse, they were especially tarnished. I mean, they took the biggest hit financially, so.
Right. The biggest loser, unfortunately.
It definitely played a role in their downfall. Just goes to show you, one wrong move and your reputation can be gone just like that.
And as if that wasn't bad enough, Nomura Holdings, they were also deep in the Archegos mess. And then, get this, they get caught up in another scandal.
Talk about adding insult to injury, right? It was almost tragic how that played out.
Okay, back up for a second. Remind everyone what went down with Nomura.
So basically, they got accused of market manipulation. The Japanese government bond market, to be specific.
Always the bond market. It's like a magnet for this stuff.
Right. But seriously, this was a classic case of spoofing. Basically, placing fake orders, to try to trick other traders, create a false sense of demand, and then bam, they swoop in and profit from the price movement.
So they're playing with fire, get caught, and what happens?
Well, the Japanese regulators, they weren't messing around. Nomura got hit with some hefty fines, obviously. And their reputation took a major hit, but they also got stripped of their primary dealer status for a while.
Ouch, that's gotta sting.
Yeah, it's like losing your VIP badge, They lost their direct access to buying and selling government bonds from the central bank. It was a big deal. And to make matters worse, some of their biggest clients, like big insurance companies, asset managers, they got spooked and hit the pause button on doing business with them.
So they're dealing with the Archegos fallout. They've got this scandal on their hands.
Yeah.
It really makes you wonder about the culture at these institutions,
It does make you think, doesn't it? What kind of environment breeds this kind of behavior? Where's the oversight? Where are the ethics?
Yeah, it's a big question. But speaking of questionable decisions, what about the man of the hour himself, Bill Wang? Where does he stand now that the dust has settled?
Well, justice was served, or at least the wheels of justice turned. He was found guilty. Racketeering conspiracy, securities fraud, the whole 9 yards.
Wow.
He's looking at some serious time. Still waiting on sentencing, but still. From billionaire to potential inmate.
What a story. It's almost Shakespearean, the rise and fall. I guess it proves that old saying, though, right? The bigger they are, the harder they fall.
It's a tale as old as time, really. The allure of easy money, the thrill of the gamble, and then reality sets in.
And it's not just about the big players, right? The Huangs, the Credit Suisses of the world. There's a human cost to this kind of financial chaos.
Absolutely. We tend to focus on the dollars and cents, the balance sheets, but real people's lives are affected by this. Jobs are lost, livelihoods are upended. It's a good reminder that finance, it's not just a game, it has a real impact.
Right. It's easy to get caught up in the numbers, but behind every number, there's a story.
Exactly. And it underscores the need for, well, everything we've been talking about, right? Ethical behavior, responsible risk management, a system that's built for stability and fairness, not just for making the next big score.
Speaking of which, we've talked about the immediate fallout, but what about the long game? The Archegos saga, it exposed some serious vulnerabilities. So has the system actually learned from its mistakes?
That's the million-dollar question, isn't it? Have we really done enough to prevent this from happening again, or are we just waiting for the next Archegos to come along? It's been a few years, sure. Everyone's moved on to the next big thing, but...
But the Archegos thing, it's still out there, right? Like a ghost story Wall Street likes to tell itself.
A cautionary tale, maybe. And a reminder. Those cracks in the system.
They didn't just magically disappear.
Exactly. We've seen some changes, yes. Regulators are definitely more wary of family offices now.
A little less trust, a little more scrutiny.
And banks. Well, at least on paper, they're supposed to be doing their homework, really understanding their clients, the risks involved.
But let's be real. It's a game of cat and mouse, isn't it?
Right. As soon as you put up a new rule, someone's trying to find a way around it.
Human nature, I guess.
That's finance in a nutshell, really. Always innovating, finding new ways to, well, sometimes to push the limits. The tools change, the players change, but the name of the game stays the same.
Greed is a powerful motivator.
That's one way to put it. And it's not just limited to, like, one firm or one type of investor. It's systemic.
It's the whole system. We saw it in 2008.
Right.
Saw it with Archegos.
The system's built for risk, in a way. As long as that's the case, someone's always going to be testing the boundaries.
Seeing how far they can bend the rules.
Yeah.
Until they break.
It's like, what's that saying? Everyone's looking for an edge. The whole system becomes the weapon.
It's a good one.
But it's true. That's why regulation is so important. Not to stifle innovation, but to, set some boundary.
Keep things from spinning out of control.
Exactly. So have we learned from Archegos? Honestly, part of me is not so sure.
I get it. It's hard to be optimistic when you've seen how this story ends over and over again.
Yeah.
But what can we do? How do we break the cycle?
Well, for starters, we need stronger regulations. Close the loopholes that let Archegos slip through, more transparency, especially with these like shadow markets, the total return swaps, all that.
Shine a light on the dark corners.
Right. But also, it's not just about rules, it's about accountability.
Ethics.
Exactly. You can have all the rules in the world, but if people are willing to bend them, break them, it doesn't matter. We need a culture shift.
Where it's not just about making the most money, but doing the right thing.
That's it. Because at the end of the day, true success, it's not just about profits, it's about having a positive impact on each other, on the world.
Couldn't have said it better myself. And on that note, deep divers, we've reached the bottom of the Archegos rabbit hole.
Quite a journey.
Unpacked a lot of complex stuff, looked at the fallout, the big picture.
Yeah.
Hopefully you learned a thing or two.
Most importantly, keep asking questions.
Stay curious. We'll be back next week with another deep dive. Until then, stay informed and, as always, thanks for joining us.